In this video, I'm going to explain the simplest way to start selling options, and this is a strategy I would do and I would use if I was starting again. My name is Luca and I sell options as for fun. This is not my primary income. I build businesses and I'm in trading space, built one of the most popular CFD or Forex trading platforms, and I just love selling options. Why? Because it's consistent, I know what I'm doing, I learned selling options, and I know this is not the most popular thing to do, but I love how much money I earn doing nothing. Basically, I trade 1 hour per week and I earn anywhere between 5 to 20,000 per month, and that's increasing. So I'm going to share my screen and explain what I do. All right, so first thing you gotta understand is most traders chase hype. They guess, they're trying to find the perfect strategy, which is very difficult, and they spend tons of time, trade full time, overtrade, guess, they get stressed out, and things like that. What we're going to do, we're just gonna avoid that. Selling puts and selling options is giving you a way not to play this game and to win anyways. So the goal is for you not to be stressed out and go crazy around your trading, is to position yourself not to win, not to lose, or to win anyways. And that is only possible with options, and I will show you the simplest way to start. So instead of asking yourself, how do I win, and force yourself to win and guess, because if you're looking at your risk to reward ratio and expecting some crazy returns, then of course you're guessing. And if you're trading short term and in the same day trying to predict what's going to happen, of course you're guessing. So just ask yourself, what should I do, and what should I know, and what should I learn, and how should I pick the stocks and strike price and everything else, and which strategy and instruments to trade, so that I never lose. So even if the worst thing happens, it's something I would like to happen anyways. So this is what you're going to do. The goal is to stop guessing, and selling puts will allow you, which I'm going to show you now, to either buy low the stock that you like and would like to buy anyways, and you will need to buy it at a discount in the worst case while you still get paid, or get paid if that doesn't happen. So it's zero panic, you will get paid anyways. And I'll give you an example. Let's say this is Apple, and Apple is right now trading at $120. Now, if Apple is trading at 120, you don't know whether the stock will go up or down. Let's say Apple long-term goes up, but right now in the next 2 to 6 weeks, it's not that difficult to predict unless there is an earnings date what will happen. Like, even if it's earnings date, it's unpredictable. But the most important thing for you is that you know that you like Apple, you like to own it, and instead of just buying 100 shares of Apple at 120, why wouldn't you sell a put contract with a strike price of $100 that expires in 4 weeks? Now, what does that mean? If the stock price right now of Apple is 120, you're basically saying, hey, if the stock of Apple drops from 120 to less than 100, I'll buy those stocks at a discount. And if that doesn't happen, I'll get paid. So this is what happens basically. Somebody who wants to buy options of Apple and believes the stock will grow will pay you $3 per share. Let's say you get $3 per share from the option buyer, because you're an option seller. You get paid $3 per share times 100 shares. That's $100, and you get paid so that the option buyers get security. You're basically insurance that if the price of Apple drops to less than 100, that you will buy it. If it doesn't, you still keep the premium. All right, so you have 3 cases. Case 1 is, let's say stock is 120, and in the next 4 weeks it doesn't drop to 100 or less. Great, you win, you get $300. Case 2, if it drops to 100 or less in the next 4 weeks, and after or at the expiry date, if it drops to 100 or less, you gotta pay $100 times 100 shares. So you gotta have 10,000 secured for a stock which you would like to own anyways. So you basically got a 20% discount, which if you like the stock, you would do anyways. Plus you earn $300. Plus, now that you own 100 shares of Apple, which is one of the best companies in the world, you can earn on the upside. So the stock will appreciate. You can sell the call, which is another strategy where you get paid on the appreciation or if it doesn't happen. Plus, you can sell another put at $80 and buy even more shares if it drops even further, which is very unlikely, and most people would love to own Apple at a discount like this. And in case 3, if the stock price starts dropping and it's close to expiry date, you can just roll it. You get your 300 premium and you just basically buy the put and sell the put at the lower price and further away in the future. So you don't have to pay for 10,000. Even if you think you will have to, you can roll the option and that's it. Like, you have 3 cases and in each of these cases you win anyways. So you have no stress. So this is a 5-step strategy that I use, and it's very simplified, but this is what I look at for when I'm picking stocks to sell puts on. I, first of all, will never sell a put on a stock that I wouldn't like to own anyways. So Apple, Palantir, Nvidia, Microsoft, Google, those are all very good quality companies where there are many smart people, much smarter than I am, who invest their energy and time into building products and earning money. And I believe they know what they're doing and they know a solution to their problems, and I would love to own those stocks. So I only trade those. The next thing is I take a strike price. When I'm defining a strike price, I'm looking at the strike price that is based on the discount at which the stock, well, I would like to own the stock anyway. So if Palantir drops 20%, I would love to have Palantir. If Google drops 20%, I would love to buy it at a discount of 20%. Those are the best times to buy, when the stock drops, because you earn money on the upside. Next thing, I always have the cash ready. If I'm selling puts, the worst thing that could happen is the stock price drops to 0 and I don't have the money to buy it at the strike price, because I am obligated if I get assigned to buy 100 shares. So I always have the cash ready in order, if I get assigned, to buy the shares. And I set the expiry date on 2 to 4 weeks. Sometimes it's 2 to 6 weeks. Sometimes it's 10 days to 6 weeks. Why? Because if I set the expiry in less than a week, things happen too quickly. It's difficult to predict what's going to happen if some news comes out and things like that. So I take it from 10 days to 6 weeks. I have enough time to react, and it's not so further away where I don't have control what's going on. I usually am happy with 1% to 4% premium per month. And 1% is as safe as it gets, guys. If you have 1% premium on Apple, that basically means that it's very unlikely that will happen. Usually the delta, which is a Greek symbol that kind of shows you also the possibility of that happening, it's usually less than 15% or 0.15. And it's as safe as it gets and gives you more return than S&P 500. Just turns out that I earn much more than 1% per month, which is great, and I'll just continue doing so without stressing out. I'll explain my strategy and long-term what I'm trying to achieve, but I just wanted to say that this video is sponsored by, or it's not sponsored by, Interactive Brokers. I wish. I'm using Interactive Brokers to trade, so you can create an account there. Other platforms that are really good, or brokers that are really good, are Fidelity, Schwab, Robinhood, and so on. And I use QuantWheel. QuantWheel is my business that I use to trade and find best option selling opportunities. Basically, you update the watch list and set the stocks that you would like to check, set the preferences on how much you want to risk and earn, and then you basically select your watch list and see all the opportunities out there, and you can filter them out based on different preferences. I'll have a video on how I use QuantWheel, but it's the easiest way to sell options because it calculates things that are difficult for you to calculate on your own, and it shows you the most relevant data, so you can just filter out the different stocks that you just like. And if you are risking of getting assigned, you can just select the stock, the expiration date, and the strike price, and it will help you find a better option so you don't get assigned, and so that you don't have to buy those 100 shares if you get assigned. This is it. This is the video for now. Let me know if you need some help. I'll organize some live calls where if you have a brokerage account, I'll show you and trade with you, show you how to make the first trade yourself.